They told you it was over. They told you the bull market had topped. They told you gold at these levels was irrational, unsustainable, a classic blow-off move. They told you to lock in profits, to step aside, to be smart money. And when gold collapsed hundreds of dollars in minutes, they pointed at the chart and said, "See, we warned you." But what if everything they told you was wrong? What if that crash wasn't a signal of weakness at all, but proof of strength? What if it wasn't fear driving the move, but desperation? Because what happened was not a normal market event. It was not geopolitics suddenly calming down. It was not inflation magically disappearing. It was not central banks changing course. It was something far more mechanical, far more revealing, and far more dangerous for those who tried to engineer it. What you witnessed was a forced liquidation across markets, a cascading margin event that exposed just how fragile the financial system really is right now. While most people were staring at red candles and debating whether to hit the sell button, something far more important was happening beneath the surface. Positions were being blown out, leverage was being unwound violently, liquidity vanished, and the same institutions that told you gold was a bubble were suddenly using gold as an ATM to survive losses elsewhere. Let's be clear about one thing right from the start. Real crashes don't bounce like this. Real crashes don't see buyers step in immediately with size. Real crashes don't attract capital inflows on their worst day in over a decade. What you saw was not a collapse in demand, it was a scramble for cash. Here's how it unfolded. As equity markets opened, heavy selling hit major technology names. Losses weren't gradual, they were immediate and severe. Large funds that had been riding the tech trade for months suddenly found themselves underwater. When those losses reached a certain threshold, the phone calls started, margin calls. Post collateral now, or positions get liquidated. In moments like that, funds don't sell what they want to sell. They sell what they can sell. They dump their most liquid positions, the ones with deep markets and fast execution, gold futures, silver futures, even crypto. Anything that can be turned into cash instantly gets hit, regardless of the long-term outlook. This is why the timing matters. The precious metals didn't roll over slowly. They didn't grind lower on bad news. They fell in a straight line. Violently during the same window, equities were imploding. That correlation is not coincidence, it's causation. And when that selling hit, something else happened that made the move even more extreme. Liquidity providers stepped back. Market makers widened spreads, reduced size, and in some cases disappeared entirely. When volatility explodes, balance sheet constraints kick in. Risk limits get hit. Capital rules matter. The result is an air pocket in price where sell orders cascade through empty books. Stops get triggered. Algorithms accelerate the move. Prices gap lower not because there are no buyers, but because the buyers are waiting lower, patiently, knowing forced selling always overshoots. This is how you get a massive move in minutes, not because everyone suddenly agrees gold is worthless, but because the structure of the market temporarily breaks. Now here's the part that separates noise from signal. What happened next? As quickly as prices fell, they stabilized. Then they rebounded. Not days later, not weeks later, hours later. That alone tells you this was not a fundamental rejection of value. It was a technical liquidation that ran into real demand. Who was buying? Not the leveraged players who had just been forced out, not the momentum traders who panicked on the way down. It was the entities that don't chase price, don't use leverage, and don't care about intraday volatility. Physical buyers, long-term allocators, institutions that understand the difference between a margin event and a macro shift. While futures were being dumped, physical markets tightened, premiums appeared, orders flowed in, ETFs saw money coming in on a day when prices were collapsing. That is almost unheard of in a genuine bear market. That is what accumulation looks like. Think about what that means. On one of the most violent down days in years, capital flowed into gold, not out of it. That is not fear, that is conviction. And ask yourself this, if the bull market were truly over, why didn't sellers press their advantage? Why didn't prices continue lower into the close? Why didn't every bounce get sold aggressively? Because the selling wasn't voluntary. Once the margin calls were satisfied, the selling pressure vanished. Meanwhile, nothing on the macro side changed. The reasons people were buying gold before the crash didn't disappear during those 30 minutes. Debt didn't shrink, deficits didn't vanish, central banks didn't suddenly stop buying, real yields didn't turn positive, geopolitical risks didn't resolve themselves. The only thing that changed was price, temporarily. This is why these events are so dangerous for unprepared investors. They are designed to exploit emotion. They are designed to force decisions under stress. They reward patience and punish panic. Let's talk about preparation, because this didn't come out of nowhere. Volatility had been building, margins had been rising, leverage was stretched. When markets are positioned heavily in one direction, it doesn't take much to trigger a cascade. One sharp move in equities can ripple through every asset class connected by leverage and collateral. That doesn't mean gold is weak. It means gold is important. It means gold is liquid. It means when stress hits the system, gold is what gets sold first, not last, precisely because it can be sold. Ironically, that's also why gold rebounds so fast. The same liquidity that makes it a source of cash in a crisis also makes it the first place money flows back once the dust settles. Now step back and look at the bigger picture. Gold didn't erase months of gains. It didn't break long-term structure. It corrected violently and then stabilized above key levels. That is what strong markets do. And while everyone was distracted by the crash itself, the backdrop continued to deteriorate. Fiscal uncertainty, political brinkmanship, currency pressure, rising geopolitical tension, structural debt issues that aren't going away with one market event. This is not an environment where safe haven demand disappears. It's an environment where volatility increases and conviction gets tested. What you saw was a stress test, and gold passed it. Think about the psychology of it. Those who sold into the crash did exactly what forced selling events are designed to make you do. They transferred assets from weak hands to strong hands at the worst possible moment. Those who held through it learned something invaluable about their own risk tolerance. And those who added during the chaos took advantage of an opportunity that doesn't come often. Markets don't reward certainty, they reward discipline. This is why understanding mechanics matters more than headlines. When you know how margin works, how liquidity works, how cross-asset contagion works, you stop reacting to price alone. You start asking better questions. Who is selling? Why are they selling? Is it choice or is it necessity? In this case, it was necessity. And necessity selling is temporary by definition. And once it ends, price reflects reality again. And reality hasn't gotten any friendlier for fiat currencies, debt-heavy governments, or over-leveraged financial systems. The bigger lesson here is not about calling tops or bottoms. It's about recognizing traps. Violent moves against the prevailing trend are often designed to reset positioning, shake confidence, and reload the trade at better levels for those with capital and patience. This is why experienced investors don't confuse volatility with risk. Volatility is the price you pay for being in markets that actually matter. Risk is owning something that can go to zero. Gold is not that. If anything, the speed of the recovery reinforced the underlying thesis. Demand didn't vanish. It waited. And when price came to it, demand showed up in force. So ask yourself where we are now. Prices are off the lows. Structure is intact. Buyers have revealed themselves. Sellers have exhausted themselves. And the same macro forces that drove the rally in the first place are still very much alive. That doesn't mean markets will go straight up from here. They never do. But it does mean that anyone declaring the end of the bull market based on a forced liquidation event is either misunderstanding the market or hoping you do. Because fear is profitable, panic creates opportunity, and every major move higher in history has been built on moments like this, moments where conviction is tested and weak positioning is flushed out. You don't have to predict every move to succeed. You just have to avoid making the worst decision at the worst time. This wasn't the end, it was a reminder that leverage cuts both ways, a reminder that liquidity can vanish when you need it most, and a reminder that when everyone is focused on price, the real story is happening underneath. The system blinked, stress showed, and instead of breaking gold, it proved why gold is still at the center of the financial world when things go wrong. The crash didn't change the story, it exposed it, and now that the forced selling is done, the question isn't what happened yesterday. The question is what happens next with less leverage, stronger hands, and the same unresolved risks staring the market in the face.